So today, the way we want to approach this webinar is from the perspective of how should we see from the boots of a NRI, not from the boots of an advisor, but from a boots of an NRI. So if you are an NRI, how should how should you invest, and if you should invest, and where you should invest as an NRI? Um, a lot of what I would be talking today actually comes from my experience as being personally as an NRI for close to a decade. And I used to live in London for that duration. And many of my experiences and learnings are what I learned on myself and how I used to be perceived at that point of time by the community of bankers who would then help me or kind of influence me in my decisions. So there, some things were great, some things were not so great. So let's kind of try to learn what things I personally consider when I'm trying to deal with a NRI myself. A brief introduction about myself: I'm a chartered accountant, and my firm's name is Banyan FA LLP. We are a mutual fund distributor from an AMFI perspective. Let's say our AMFI code is 258420. These are regulatory disclosures which I have. And if we move ahead, we would be talking a lot about matters related to non-residents, taxations, but a lot of it would be generic in nature. My strong suggestion would be please do not consider it as an investment or tax advice. And for your specific requirements, please reach out to your respective financial advisor or a CPA or a chartered accountant to assist. I've tried to make sure that the whatever we have is accurate, but please, I don't warrant that it is actually going to be accurate. Sorry about that. So with that, let's move ahead into the presentation. And what would we cover today? Quite a lot of things, honestly. So we will start with actually the very basics. As I told you, it will be a lot about basics over here as well. That who is actually an NRI and who's a non-resident, and some basic categories about it. What is a requirement of an NRI from their perspective when they want to invest in India? A very ignored item, rupee depreciation. I call it as a silent killer of your investment returns. To understand more about it and its implication, what are the investments where NRI could invest in India? Little bit about taxation, excuse me, taxation in India, and also two specific geographies which are quite interesting to understand tax implication in the respective geography for the NRIs. Then you'll talk about a little bit of NRI banking, NRE versus NRO, what are the strengths and where they could be considered. And lastly, you have invested money in India, you want to take it outside. How does it work? Okay. So let's go into non-residents, residents versus non-residents. It's not very comprehensive. I've made it really very at a high level. But just to give you a perspective about how this works, there are many, many finer prints associated with it. But let's try to understand on a high level that who is a resident and who is a non-resident. A very broad definition about a resident and a non-resident is influenced by number of days in India. So if a person has been in India physically for 182 days or more, or has been just in India for around 60 days, but previous to that 4 years, roughly 365 plus more days in total, the person would be a resident, else a non-resident. Now, there are other finer prints associated with it, which are associated with your citizenship, your person of Indian origin, your overseas income of 15 lakhs, visiting in India, and so on and so forth. I'm not going to the details of that because the idea is to kind of give you an overview that there are two types, resident and non-resident. And within resident, there are two further subcategories. One is called resident, but you are an ordinary resident, matlab 100% resident. Second, resident, but you are not a 100% resident. This basically a provision which helps when you take it this way. Let's say you have been living outside India for a decade and now you are coming back to India. It takes some time to settle your overseas affairs. Now, you do not want that while you are settling your overseas affairs, India starts taxing you At the same time, the overseas country is also taxing you. So this is, you can call it as a grandfathering clause, which gives a person who has been living outside India for quite some time, let's say a couple of years, to settle their affairs, and that doesn't result in taxing them in India. So that's where this clause is very, very helpful provision for NRIs returning back to India after spending a lot of time outside India. So that's what that clause is. But to know whether you are a non-resident but not ordinary resident, you need to be kind of complying with these conditions, that you have been resident in India for 2 out of 10 years and 730 days in last 7 years. So if you see, there's a little bit of calculations here. The idea is not to kind of become experts over here, but to know that there are two categories of residents and ordinary and not ordinary, and they have an implication on how your money is taxed both in India and outside India. Let's see how it works over there, right? Let me just go into a little bit of my chat window to see whether there are any chats messages coming in. So I just wanted to let all of you know that while I'm presenting, I won't be able to look at the chats. It will all be minimized for me. So there might be a delay. Okay. Ahead. The three categories: resident, ordinary resident, ROR, not ordinary resident, NOR, and non-resident. What's it? Why do we differentiate between three? The key reason is this. If you are an ordinary resident, matlab you have been living in India for a long time. So person like, for all practical purposes, people living in India are actually under this category. Your global income is taxed in India. What does it mean? India income will also get taxed along with your overseas income. If you have any income outside India, any investment income, they all will get taxed in India. Okay? The complete opposite is non-resident. Your Indian income will be taxed in India. But your overseas income, your global incomes, will not be taxed in India, but it may be taxed in an overseas country. What does it mean? I'll give you an example. Middle East, there's no direct taxes. So a person who's a non-resident, if he's earning in India, let's say there's some investment income, their income in India will be subject to tax in India. But Middle East doesn't have a tax structure for their normal incomes. So it will, their local incomes in Middle East won't be taxed in India, in India as well as in Middle East. But let's say if you are living in the US, your Indian income will be taxed in India. Your US income will be taxed in US. But the US would consider your global income as a part of your overall income. So they may club both India and US income to tax them in the US. So that's the two things, the polar part. In the middle, the transitionary clause, where the person has returned to India, is still not a full resident, is not ordinary. Indian income will continue to be taxed in India, but global income may still be continued to be taxed outside India. Because the person, let's say the US actually taxes all of their residents globally, irrespective of whether they're living in the US or not. The slight bit of differentiations which we need to note is, in all of these categories, Indian income will be taxed in India, whether you are resident or not resident. Let me make it simple. Indian income will be taxed in India. Now, change your perspective from your respective country. So let's say if you are a non-resident living in the UK, your global income will be taxed in the UK. Right? So why I'm trying to bring this into perspective, at times the non-residents think, or the advisors may think, or the bankers may think, Indian income is taxed in India, then forget about that income in your respective country. No, it is not the right way to look at it. A non-resident must always look for the global income and think that this is to be taxed in the respective country outside India as well. Okay? But once we understood a little bit about the categorization of residents and non-residents, let's try to think about other perspective, that what is a basic requirement from a non-resident's perspective, right? If they're bringing in the money in India to invest, what do they want? Effectively, the requirements are as simple as a person living in India. It's their expectation. Very, very simple ask. If you are sending money to India, let me just kind of go back on the chat. And all of you, if you could do me a favor, go on the chat and think about when you are transferring money or you want to invest in India, What are your basic requirements? What are your basic asks? You want to put the chat on your chat. What are you after? I might give you a little bit of steer. You want returns. What other things are you looking out for? Diversification. Oh, yeah, good. You want returns. You want diversification. Thanks, Aditya. Any other things? Any other thing comes into your mind? Leveraging on capital gain benefits? Yes and no, hit and miss. Depends upon the country you are in and where you have invested. Higher returns, protect it close to home. Could be a good idea. Nationalism spirits could also come in here. High returns compared to the country residing in. We will definitely touch upon that. So Vishal, thanks for that. Ease of access to money, Pankaj. Yeah, that's a very, very important one, that I should be able to get my money back when I need it. Bank account, rebates in India, RBI permission. Yeah, the RBI must not kind of change the norms by once you have invested so that your money gets taxed. Capital gain protection. Okay, capital protections. Thanks, Amir. Okay, good point. Let's kind of get back into the presentation and see again what are those basic asks. First, people want growth. It's not just non-residents. Everyone wants growth, right? We want higher growth, or we may want a diversification. Like if let's say someone is living in Australia and they may be expecting higher returns on their money. At the same time, they might also want to kind of avoid putting everything in Australia and maybe putting in other countries. India may be one of their go-to point. Second is, as it was mentioned in the chat as well, we need hassle-free access to our money and its value. It should not be a situation when putting in the money, it's so easy, but when you want to take it out, it is all prone to hassle. We will see the key mistakes which could happen to make your hassle-free journey an extremely cumbersome process while taking it out. And that's where this particular part comes in. When I want my money, I should be in a situation that I should not be stuck. That money should not be stuck. It should be easily going out. And then it should be tax efficiency. Both, when I say tax efficiency, it should be considered from both points. Your tax in India and overseas tax as well in the respective geography where you are in, right? So these, I think, are the four basic things which I came across, which are important from a non-resident's perspective when they are trying to invest in India. Now, a key part is when a non-resident is trying to invest in India, there are few costs which a non-resident ends up paying to put their money in India. Let me see from our people who are on the chat. Guys, let's say assume you are living in Middle East and you want to transfer dirhams to India to invest. What is your cost of investing? What do you think when you're transferring money and investing? Is it all free or there's some cost associated with your investments? Think about it on the chat, please. What do you think would be the key cost associated for you? I'll give you one hint that will make you think about the way. When you're transferring money to India, you first of all incur, there you go. Thanks, Aditya. Conversion cost, foreign currency conversions. That's one of them. Anything else you can think about? What else could be impacting or eating your money's growth? Currency risk, rupee depreciation, fantastic exchange rates, advisors fees, fund fees. Yeah, perfect. I think so. You guys, you've nailed it. These are the key challenges. Let's kind of see in a more detailed manner that what are those key things. First, remittance cost. People often do not realize that when you are converting your foreign currency and sending it to India, there's a one-time remittance fee. It is implicit in the foreign currency rates. Depending upon how efficient your transferring platform is, it could be as low as 1% to as high as 4-5%. I've just considered on average 2%. That's what the cost ends up being when you transfer your dollars, euros to India. The next one is reverse. Why just one-time fee? When you transfer the money to India, you also need to consider you will take it back as well. At that time as well, the same cost will apply, right? So one fee to transfer money in, second fee to take it back. The third cost, taxes. Okay, you might argue, if I invest in my respective country, I'll be taxed anyways. So I could ignore the overseas tax from that perspective. But I'll tell you where overseas taxes might be a drag. Specifically, you invest outside your respective geography, but your Indian taxes may also play a role. That's also one of the costs of investing. And my silent killer, rupee depreciation, INR depreciation, that could take easily 2 to 4% of your returns. We'll look into a more detailed example in the coming slide on this one, right? And lastly, opportunity cost. Let me before that ask on the group. I'm seeing many people who are from overseas geography in this webinar. Guys, if you invest in your respective geography, so example, if you are in Middle East, you're investing there. If you're in Singapore, you're investing. You are not keeping your money idle in many of the cases. You might be investing. You have some avenues to invest. You are in the UK or in the US, you're investing somewhere. What do you think you can easily get as a percentage returns per annum? Long-term period, not short-term returns. And don't get influenced by the COVID kind of influenced double-digit returns which people got. What do you think in your respective geography is a sustainable long-term return which you may get? Shardul Singh, thank you. 10%. 10% is achievable. Okay. Ankit says 6 to 8. RKC 8%. RP says 5% dollar returns. Sudhir says 7%. Right. So good to see this because Saurav says 15%. I hope all of you are seeing on the chat. It's not zero. When I talk at times to the relationship managers in the banks or in some other communities, at times the assumption which I have heard and which I used to be told as well when I was a non-resident, you live in a geography, low growth, you don't get any returns, invest in India. And over a period of time, I realized that it is not the right way to look at things. There is an opportunity cost. People are investing outside India and the returns on a reasonable basis could be 3 to 10%. It's not that their money will have no avenues. So whenever we start thinking in the direction that NRIs do not have any ways to invest in their respective country, it starts at a very wrong foot. Let's now look into details on this particular part. This is the most painful part for a non-resident while investing in India. And this should be one of the critical parts which a non-resident must consider while deciding whether they want to invest their money in India or not. On that point, not just India, any other geography they're talking about, right? INR depreciation. Let's take it. I'll take a little bit of table. I'll explain you what it means. So long dated returns. Let's assume in January 2021, when US dollar INR transfer rates were 44.75, a person invested $1,000 in India. So the money was transferred in India. At that time, if you see, while the rate of interbank return, which is basically the common rate used for transfer, was 44.75, owing to a 2% markup, the expense of transfer, the person was given around 43.86. Again, all of these are assumptions, right? You can use your assumptions as well. So $1,000 got transferred to India at 43,000. And I've taken just as an illustrative scheme, no buying or selling recommendations, a Kotak FlexiCap, because it has a long duration. I could have picked up anything, or to that matter, I could have picked up Sensex as well. But hey, let's proceed. At that time, the NAV or the value of this scheme was 12.48. And this many number of units were bought for 43,000 in 2011. Fast track in 2024, the NAV of that amount zoomed up from 12.48 to 83.21. It's a whopping return, not a small return. Translating into Indian rupee, the 43,000 which was invested, it grew into 2.92 lakhs, right? The compounding return was 15.7%. 15.7% returns. On the chat, first of all, do you think 15.7% is a great return? Let's say if you're getting 15% compounding return over 1.5 decades, do you think it's a good return? Yes or no? Yeah, Ankit says awesome. Sudhir is not happy, maybe more. Yeah. For most people, I would think yes, as people are saying, it's a great return. And I've not used a state of the art or even like a chart buster kind of a scheme. I've just used a scheme which has a long track record. Now, let me ask you a question. What do you think would be the same return in dollar terms? Think about it. A person has transferred his money to India, invested in Indian rupee, and now is going to transfer that money back to the respective country on 30th July. What do you think from a dollar perspective is his return? Amit G says 8 to 9%, RKC 7.5. Any other guesses? Any other guesses, guys? Pratik says 10, RP 6. Right. Let's see. Let's see what exactly was the number. It was roughly 10%. Around close to 6% or 5.8% return was eaten away by INR depreciation. When you're looking at the bull market returns of 15.7, our dollar adjusted returns are 9%, 9.5, or say 10%. By all means, let me be very, very open with you. It's a great return. A dollar return 10% is an awesome return in my view. Let me ask you guys, do you think 10% dollar returns, is it a great return? Yes or no? Or do you think, no, ye dil mange more, it has to be more? But I'm just trying to see, I saw the returns which people living outside India was thinking about it. And dollar return, yes, that's the point which Himanshu is about to come back. What about the tax? Yeah, we'll discuss about it. But effectively, dollar adjusted return 10% is a great return in my view. The next thing to think about is, what if this dollar adjusted return was 6%, 5%? I'll give you a scenario and I want you to kind of again react on the chat. Ignore tax for now. Ignore tax for now. Let's say you were investing in a fixed deposit, NRE fixed deposit, tax-free in India, giving you 9% return. 9% return from an India perspective is, in my view, I think in a safe return category, is a super good return. Guys, do you agree with me? A fixed deposit, safe return, tax-free in India, 9%. Is it a great return or not? What do you think? Right. I don't think there's any argument about it. Safety parameters, fixed deposit, NRE, perfect situation to be in. If you adjust it for only this one criteria of INR depreciation, I won't be surprised that 9% drops down to 5%. Do you think 5% dollar return is still a good return? Again, safety. What do you think? I still think depends. Safety perspective, say if you compare FD to FD, maybe fine. But now with the parameter of inflation, yes, Mr. RKC has said inflation and tax. Let's bring into the next part over here, that tax will further kill the returns which we have. Something which is tax-free in India does not mean that it's a tax-free. situation in your respective country. So if you are, let's say, living in Middle East where you do not have to pay further tax, then your decisions can be made at this point itself. But if you are living in higher tax geographies like the UK, the US, the Eurozone, you must then consider the impact of tax on your returns as well. And then to ask yourself a question, which is the bottom line here. If adjusting to these things brings your returns to sub 8%, would you want to invest in that specific asset class? So the whole idea I'm trying to put across is to help you all appreciate this silent killer, the INR depreciation. So let's look into another bit of picture of it from an asset class perspective. So the first one, as I was giving you NRE fixed deposit example, you can be an NRE fixed deposit or a NRO deposit, or you might be just invested in some long-term bonds. I'm aware of so many people who still being an NRI continue to invest in PPF accounts, legal or not legal. I'm not going to talk about it, but what I'm trying to tell you is that this category of investment in India, the max you may be getting is 8% at this point of time. Interest income may be tax-free in India. Example, NRE. But point you should appreciate is that it is not always tax-free in your respective geography. I'll give you an example of the UK, and that may be applicable in the US and in the Eurozone as well. If I get 8% interest income, and if I'm in the higher tax slabs, I might have to pay 40% tax on it. So at times when the banker gives a call, sir, the return, we have a very fantastic NRE returns and FD returns of around 8%. Give yourself a thought. 8% tax-free in India may equate to around 5% after tax in the in your respective geography. And on that, then apply these two concepts. To do a fixed deposit in India, you would first end up paying 2% as the foreign currency rate, and then another 2% to take it back. So both sides total one time 4% gone. And then the INR depreciation. I don't know how long India will continue to depreciate, but from my living memory, I remember Indian rupee has always depreciated. Hopefully it may not, but if it does, then it might again take away another 3% 2 to 4% of your returns. So what will you get in hand? What do you think? So if we kind of go back into the chats as well, 8% NRE fixed deposit, less tax, bringing it to 5, less another 4% or 3%, let's take 3 in terms of your INR depreciation, you're left with 1 to 2% return. So guys, 1 to 2% is the best case situation. Hand on heart on the chat, if you are a non-resident living in your respective geography, for 1 to 2%, will you trouble yourself to put your money in India in fixed deposits or debt or bonds? Hence, open yourself to these points and take decisions before transferring your money to India. The moment you transfer your money to India, you have incurred 4% cost, 2% one way and 2% other way. And then the INR depreciation kicks in. So please, this is one first asset class, debt. Let's look into the second asset class, gold. Okay, let me ask a question. Guys, do you invest in gold? Type Y for yes and N for no. Do you invest in gold? Y for yes, N for no. So I am seeing 1, 2 Ys, yes, no, yes, no. So I'm seeing both of more responses, please, because it will be a very interesting eye opener. We have a very detailed video on gold investing, whether gold is a good investment option or not. You may want to refer to our YouTube channel on that particular video. It will be an eye opener that why gold and what role can gold play in your investment philosophy to quiz yourself. If you are investing in gold, tell me one thing, what is the underlying, what return can gold give over long durations of time? Give me your estimate. Come on. gold in long durations of time, how much return can it give? Prateek says 8%. Sudhir says it's volatile. Oh, indeed, it's not a safe asset. It's volatile. 8 to 10%, 5 to 7, cannot be predicted. 8 to 9. Yep. That's good enough. I think I got long-term dollar return of gold is 6 odd percent. Yes, depends upon when you bought and when you're trying to look at the value, you may get higher or lower returns. But what I've seen is long-term dollar return is roughly 6%. And if you convert it into Indian rupee perspective, add another 2-3% more. So if from an Indian parlance, gold might give you around 10-ish. From a dollar perspective, around 6-ish. I'm not putting the tax perspective. But let's see the circumstances which gold gets impacted. When I have often seen NRIs transferring money in India to buy gold. Think about it. When you're buying gold in India, gold is a dollar asset. It's denominated in dollars. When you buy it in India, you are actually converting. You're not getting a different variety of gold. It cannot be like it's an Indian gold. No, gold is gold. Buy it from anywhere. And the price of gold is denominated in dollars. You pay in Indian rupee, it's multiplied by the prevailing Indian rupee. But what you get in India is one more pain. You pay taxes on gold. In India, till this budget, till July, the taxes were approximately 18.5%. So what it means, gold in India was around 18.5% more expensive. Same thing, no difference. But you pay 18.5% more. And what happens if those taxes are reduced? Gold value goes up. That's what happened just after the budget. The gold prices in India tanked by 9% overnight because the government was kind enough to reduce the tax rates. So if it is a universal dollar asset, why do I want to pay 9% extra to buy that asset? One. If it's a universal dollar asset, then while buying it, should my mind not think about from the perspective of where I'm getting it the cheapest and convenience that I can access it? Example, let's say you are sitting in the US and you bought gold in India. Now just think about it. If you need money, how will you get access to that money? Okay, the situation might be slightly different. People may have money in India and they bought it from there. That's a separate example. But still, in that case, if you wanted to invest in gold for that money, I would rather say take that money back to your respective country and buy it in dollar terms over there. Because at least when you will need that money, you want to access gold, you can sell it off and use it there. But if you put it in India, locational challenges, right? A brilliant way of perhaps accessing gold could be through electronically gold ETFs. Gold funds. I'm not touching the topic of sovereign gold bonds because SGBs or sovereign gold bonds is not allowed for NRIs, and hence there's no use of talking about it. And I don't know the future of sovereign gold bond after the current tax reductions. Maybe they may gradually phase out. I don't know about that. So this is for non-residents. These are the categories I'm thinking for gold. When you buy gold in India, even through the digital means of ETFs and gold funds, the expense ratio which you pay is higher than your respective countries. In that situation, the second asset class of gold, in my view, if you want to invest, the best place to invest is in your respective geography, not in India. Okay? Second. The third one is the equity spectrum, but the spectrum of international investing. The thing which I've seen is, let's say, post-COVID, there's been a lot of awakening of global diversification. And I've often seen non-resident money flowing into India to be invested in the US, like in the tech companies of the US or the NASDAQs or the S&P 500s of the world. So the third part which I want to discuss is overseas investing. And we've just taken US as an example. And two major indices of there, NASDAQ and S&P. Again, if you're sending money to India to invest it back in dollar assets, I find it a little bit of not so logical way of approaching two things. One, by doing this, you incurred foreign currency transaction costs. Secondly, you're paying too much in India. Your expense ratios is a fraction in the similar assets in the overseas countries. Plus, what are you getting out of it? You're not getting any separate, different kind of an investment. It's the same investment. Do it in your respective geography. It also increases the ease of accessing that money, right? But there could be some use cases of investing in these investments via India. Not ideal, but some use cases. Let's say you, as a non-resident, are living in not so developed financial markets. And as a result, you want to invest in these geographies, but those financial markets are not giving you an avenue to invest there. In that situation, yeah, then it might be a situation to send your money to India and then we explore those options. But it is by exception, not as a norm, right? So these were the few things which I wanted to make. I wanted to kind of bring these topics in your mind as a non-resident or as an advisor or as a mutual fund distributor to think this way, that when a non-resident is transferring money to India, just think about the underlying asset, the outcome, the return outcome of that asset, and the INR depreciation and the tax, and then think whether this money should be invested in this asset category, all in totality rather than just one ki return banana hai. Okay? From here, we touched upon a topic of tax. There were quite a few things on taxes on the chats as well. So now what we will look into is taxes. I will not make, these are not going to be very, very granular tax details, but they will be just enough to create some kind of awakening and create an interest to think from this perspective as well. I'll try to simplify it. It has actually, these presentations have been simplified. Have been simplified to make it easier to understand the concept. So there are many, many finer prints, which I would assume that in that particular case, you have to sit with your respective accountant to discuss them. So let's see the situation. First situation we'll see is not just India, but overseas and India. Both have to be looked together for non-residents. You may not be competent to do it yourself. In that case, you need a team of someone who knows about Indian taxation and the respective country's taxation. My suggestion would be, this is not an area to be a DIY, do it yourself. Perhaps some level of consultancy might be required here. So taxes in India, we'll see in the next slide. It's relatively simple. What we need to then also appreciate is India will tax, overseas economy may also tax. How do we avoid double taxes? So we will do a little bit of overview of double tax avoidance agreements. Overview only, not a detailed deep dive. And lastly, appreciation about the overseas countries' taxes as well. Very, very critical. Okay? So let's see the Indian tax perspective. To make it simple for you, there's not a lot of difference. Non-residents in most cases can use the same tax laws, tax rates, exemptions as a resident. There are nuances. They're very, very minor and limited nuances. I'll give an example. It's just as an example, like short-term capital gain in equities in India. If you are a resident, up to the tax slab which a resident enjoys, you don't have to pay tax. But in case of non-resident, from rupee 1, you have to pay tax as short-term capital gains, right? There are a very few limited such nuances. Broadly, it tends to be similar. So you don't need to be kind of getting very, very worried, both as an advisor and an investor, that I have to now go into the whole plethora of non-resident taxation in India. Jarurat nahi hai. In most of the cases, it will be same. Okay? And to make it a little bit easier on the taxpayer non-residents, there are certain provisions that you do not always need to file a tax return in India. The section 115G, you can have a read over there. It says that if your earnings are through investment income in India, then and appropriate tax has been deducted, then you don't need to file a tax return. But I've seen people doing the opposite. They've got all sort of incomes, no TDS has been deducted, and they are still not filing the tax. Then you're inviting trouble. Okay. The third one is If beneficial, invoke double tax avoidance treaties. If not, sleep over it. Chota amount, don't bother about it. Many people file tax returns just to claim refund. Let me put it this way, that there's more tax deducted in India than they are required to, and they claim refund out of it. To understand a little bit about double tax avoidance agreements, which is this part, let's look into a sample double tax avoidance agreement of the UK and India. A full repository of it can be accessed here on income tax website. The whole idea of a double tax avoidance agreement is to avoid double tax. Example, you invested in India, India taxed something, and now UK will also tax. But then the person will say, I earned the same amount. Why are two countries trying to tax me doubly? I'll be left with nothing if I kind of pay both of them. So in that case, there are norms to give you credit. If country A deducted tax, okay, I'll give you credit. I won't deduct to that point, and vice versa. So let's read this one example. Blah, blah, blah. There's a lot of things, but let's look into the highlight part which I have. That subject to the provision of United Kingdom regarding allowance as a credit against UK tax of tax payable, Indian tax payable under the laws of India shall be allowed as credit against United Kingdom tax. In simple terms, what it is trying to say, that UK may allow a credit of tax paid in India. आपने इंडिया में टैक्स पे किया है for your income, UK will give you credit of that so that you do not end up paying double tax. Very, very simple. I've given very simple example. Please, there are a lot of more nuances to it. The objective of this one is to just help you appreciate how does a double tax avoidance agreement looks like. Now let's look into another double tax, the same agreement ka clause on certain investment incomes. That how does it work? So again, the UK and the India double tax avoidance, what it's saying is that each contracting state means India is a contracting state, UK is a contracting state. What they're saying, each state may tax capital gains. Matlab, India will also tax, UK will also tax. But let's talk about interest. What is saying? That interest arising in a contracting state, which is India, and paid to a resident of the other contracting state, UK, may be taxed in that other state. What does it say in simple terms? If you have been paid interest in India, then UK may also tax it. However, India may also tax it, but at max at 15%. But over here, you might think that looks like both of them are going to tax me. Where is that double tax wala part? Where is that avoidance wala part? That's what in the previous example was here, that they may give you an exemption of the amount which you paid in the other country, right? So this is just a very high level flavor of how that a concept like DTA exists. And if there's something complicated, then you need to get in touch with your respective countries' accountants to be able to assist you there, right? As I'm mentioning here, please, where possible, avoid your do-it-yourself approach here. It can be complicated. And even within the respective chartered accountants or CPAs, there are not all chartered accountants specialize in this area, or not all CPAs do. So you will have to find out the one who actually specializes in international taxation, right? The next thread of it is that we need to also appreciate overseas taxes. When I say overseas taxes, if a non-resident is living outside India and is investing in India, India will tax. But what about the taxes applicable to that person in their respective country? Let's say in this case, a UK. So what will be the situation? There are actually two countries over here, two types of groups which I will classify. One group of countries are relatively tax neutral to tax friendly. Example, they will not tax further on capital gains. They will perhaps not have any more taxes at all. The two examples which I've given is that I'm aware that in Singapore, they won't tax on capital gains. So if you made even millions of capital gains in India, in Singapore, it's tax free. Middle East may not have any taxes. So I categorize that into the bucket of tax neutral to / tax friendly countries. The other category of countries which I think is, I'll call extremely punitive, bordering they want to discourage their residents to invest outside the country. What are the level of kind of penalties or tax disincentives do they put in? The first one, they would say complete disregards to capital gain. They'll say, we do not consider any capital gain outside India. Oh, sorry, if you are living in the UK, for example, and if you have a capital gain in unauthorized investments, we will not consider it as a capital gain and we will not give you that preferential tax rates. We'll rather consider it as your normal income. And if you made a loss, we'll ignore that loss as well. So I call it in जो हिंदी की कहावत है खाया पिया कुछ नहीं ग्लास थोड़ा बारह आने वाला concept for non-residents. So you may have a very, very high tax impact in these geographies. Till date, I've been able to find two, US and UK. There might be others as well, sitting somewhere, hiding somewhere in the tax books. But these are two which I've got practical experiences. How? We'll now look into those examples of those two cases. First one, US. A very, very interesting one. US has a concept called passive foreign investment companies, PFIC. Rarely NRIs living in that country also know about it, I've seen. What PFIC says, it's not specifically limited to US residents investing in India, but it could be in any geography which does not comply with US IRS and SEC's requirement. And they say that a PFIC is actually a foreign investment vehicle, which results primarily in passive incomes like interest income, dividend incomes, and those kind of things, capital gains. And if any investment where you invest in, let's say a US resident is investing in an investment in India, or let's say even in, let's say, for argument's sake, let's say Singapore or any other country, and it is classified by the US IRS as PFIC by their definitions, then a couple of things happen. They say, US IRS says, I will not give capital gain benefits. Rather, I will consider it as your other income, which means the most punitive tax income. They will not allow carry forwards of taxes. And if this was not bad enough, even worse, they may even tax it as unrealized gains, mark to market. Example, you invested 100,000, stock markets had been kind, it went up to 150,000, you did not sell. You're still holding on to it. But as per the law, they would say, okay, 100,000, 150,000, differential 50,000, that's your income for this year. Add it to your normal income and pay tax on it. Some people, when I tell them, they think, Puneet, kya bhang kha ke aaye ho tum? No, it's exactly, this is law. You can search by the term PFIC and you'll realize. If I talk particularly for investing in India, I've realized that most of the investments where we invest in India get classified under PFIC. All the mutual funds, pension funds, ETFs, index funds, to that point, REITs, real estate investment trusts, the ULIP policies or the endowment plans where you invest, they all get categorized under this one. Implication? If you were doing the same thing in US, for example, let's say the tax rates would have been 15% for capital gain, you get subject to a normal income slab, and that too on an accrual basis. Very painful, very, very painful. On the chat, I wanted to check with you. People who was not aware of it, can you just put N if you were not aware of PFIC? On the chat, were you aware about PFIC? Please type N if you were not aware. So, and this is a fact. Most of the mutual fund manufacturing, in terms of the company's relationship managers, the bankers, advisors, to my view, are getting aware of it and they're more aware of it. But investors themselves are not aware. And it's better that I wanted to spread this awareness because you can avoid a very painful conversation with your US tax IRS, right? It could be practically, you may not have seen practical examples of it getting enforced, but I just want to ensure that I personally, for US guys, I'm very, very conscious about it. And I make sure that they're aware about it and they're taking their own calculated risk. Okay. Let's take another example. UK, United Kingdom. UK may not be as bad as US, but they are not good as well. They have a concept called non-reporting funds, overseas non-reporting funds. And if a fund or an investment structure gets classified as a non-reporting fund, what happens? Basically, it's not classified as capital gain in simple terms. They don't do the accrual mark-to-market tax, but they say whenever you sell, whenever you switch, whenever that thing called capital gain happens in India, the income has to be reported in the UK, but it will not be classified as capital gain. It will be classified as your other income. And if there's any loss, we'll not give you any credit of that loss. Implication? A UK dividend is roughly taxed at this rate, 8.75 to 39%. I've just updated with the latest tax changes. And the capital gain tax in the UK is from 10 to 20%, and around £3,000 in the UK is exempt. Like in India, you've got 1.25 lakhs of exemption. UK has just now reduced it to £3,000. It used to be at 1.5, 12,000 pounds of exemption. So effectively, a lot of the money would be exempt. But when they say it will not be classified, it has been classified as non-reporting fund, forget about this. Normal UK tax, whatever tax slab you are in, pay tax on it. I find it, again, a little bit painful for UK tax residents. So again, I'm asking on the chat, guys, are you aware about the UK non-reporting funds concept and that how it can negatively impact your investment decisions? So yeah, it is what it is. So thanks all of you for typing on there. So okay, then what do we do? I mean, I'm just not trying to spread only negative views about it. There are ways of kind of investing, because the point is it should be not a non-reporting fund, or it should not be a PFIC. Then how do we kind of tackle to it? Let me try to summarize a few of these geographies together. Again, not a tax advice. Please consult for specific cases. I have categorized like these common investments: mutual funds, active or passive both, ETFs. Again, ETFs are nothing but a mutual fund listed, right? ULIPs, insurances, the insurance products, and alternative investment funds. The green is where in these geographies I've not come across any painful tax situations. Yes, there might be a situation for Canada, for example, that they might want disclosures while investing, but I've not come across any punitive tax treatment of investing in India in any of these products. For these countries, yes, there has been a situation. AIFs, you may have certain AIFs which comply, but you have to be careful about these alternative investment funds that they may also fall in this territory. So with that, let's try to see then what are the options? What are the options? I see assets like investing into 4 critical assets or 4 logical assets which are there: equity, debt, gold, and real estate. So if you saw in the previous examples of these 2 geographies, the word was funds in both of the cases. So perhaps the way to avoid those punitive taxes is stay away from the fund and go into the direct raw asset. I'll give you an example. Let's talk about gold. Do not invest in Indian gold funds. Either invest in a raw gold or take the money outside and invest there. Then you can avoid that situation. Same for debt. Instead of investing in debt funds, maybe a better situation would be this way. Or in case of equities, so when you are transferring money, as we saw, that your minimum cutoff could be around 8% dollar returns. So the only asset classes which may perhaps make that cut might be this area. And if I just talk from a perspective of equities, instead of going into a fund avatar, go into a direct equity avatar. In other words, what is a mutual fund? It has got multiple stocks inside it, managed by a fund manager under a tax efficient wrapper from an Indian perspective. Now, what you're finding is the problem is not with the stocks, the problem is not with the fund, the problem is not with the expenses, it's that tax efficient wrapper of fund in India. break that apart and directly invest in those stocks. Now, the challenge is if you directly invest in stocks, then you should be aware of how to invest. One. Second, selecting and monitoring those stocks. If you can do it yourself, perfect way, direct equities. But if you cannot, a managed way of doing the same thing is called portfolio management services, in which your ring-fenced stockbroking account, demat account, NRE account are all opened and stitched together under power of attorney arrangement with a fund manager. And the fund manager, just like in the mutual fund, was taking their autonomous decisions based upon the strategy of the fund. The same thing they will do here. They will not ask you. They will do the buy and sell in the portfolio. And as the portfolio grows, you will see the equity growth coming into your portfolios. But now you are not holding units. In case of funds, what do you hold? Units of that fund. Here you hold direct stocks of that particular in your demat account. You get dividend incomes, which you were not getting in case of mutual funds. Now you go and merrily disclose it in your respective countries. They will then be classified as a respect. Let's say if dividend is coming, it will be classified as a normal dividend income. If you have a capital gain in India, it will be classified as a capital gain in India. That's what I have experienced. But the whole idea of fund is something which I found was something not appreciable and hence resulting in those tax implications, right? Other bits let's talk about. So this wraps up the element around the tax part, Indian tax and overseas tax, and stitching it together into what products you should consider from an Indian perspective. The next one which you now need to understand is the banking in India. Many may already be aware, NRE and NRO banking, but it may not harm a quick refresher in case you are not aware that there are broadly two types of bank account in India from a non-resident's perspective. A NRE account and a NRO account. In case you're not aware, it's just like another saving account in India, which people in India have. The only difference is NRE account can only get inflows from outside India's remittances. So let's take an example. Let's say you are living in the US and you have opened an NRE account in India. You transfer your dollars, it will convert it into Indian rupee and will be credited into that bank account. So it can accept inflows. You can also do all kind of outflows from that account like a normal saving account. You can invest, you can expense, you can pay holidays, you can pay bills, whatever you want. You can buy real estate, everything can be done. But there's a restriction in the inflows. One was overseas remittance. Second, financial assets which have been invested through NRE can be credited back. To help you understand the negative part, that you will be able to understand it better. If you bought a real estate, or let's say you gifted your friend or gave a money as a loan to a friend in India, and now that money is coming back, it will not be credited back. Which one will get credited back? Let's say you invested in stocks and sold them, it will automatically get credited. If you give a loan to someone and it's coming back, it won't get credited. So for your requirement of ongoing inflows and outflows in the country, like you have a rental income, or you have some kind of money locally in India, which was already there before you became a non-resident, that's where the NRO comes in. Both of them are exact Indian rupee equivalent funds. No problem other than that, right? Considering the NRE account restricts what gets inside it, the possibility of untaxed money getting credited in this account is remote. And hence, this money can be freely repatriated outside the country without any restrictions. So when we're talking about ease and hassle-free, your investment is hassle-free if it is done through NRE. But if you have done the same money, so let's say, for example, it can be better understood through this slide. Here is an NRI living outside India, overseas dollar account. And this border is where India is. This whole thing is India. The person can transfer to NRE. This is incoming coming in, and can invest in mutual funds, fixed deposits, stocks, or real estate. I could draw another one like giving loan to people and relatives. So if you see, in both sides, you invest in mutual fund can be credited back. Invest in fixed deposits can be credited back again. Stocks can be credited back again. Once it is credited, you just use a wire transfer form. In many cases, it will become electronic as well, and money is out. Very, very hassle-free. The only hassle may come at times is your banker might say, "Mujhe physical form de do." Other than that, it's all hassle-free. But see how you can very smoothly or through ignorance, convert a hassle-free into hassle. Instead of transferring money to NRE, you may end up transferring it into NRO, purely ignorance, or you don't have an NRE account, or to that matter, saving account mein kar diya. Same thing will keep on happening, no problem. Till such time now you say, I need the money back in my country. The moment you do, there's the gate sitting over here. It's called Form 15 CSCB. Now, the challenge, if you see over here, will be more evident through this arrow. When you transfer money to NRE, and we'll take this real estate example, you could buy real estate, but you cannot, if you want to sell it or there's any rental income, you cannot credit it back because it is all ring fenced so that there's no restriction on transfer the money back to the respective country. So the government and the RBIs have to ensure that no untaxed money gets credited over there. So they have to put a gate between it so that untaxed money cannot come in. So when you sell a real estate, it may not always be a very clean transaction. So hence, when you sell a real estate, even though you paid the money through NRE, the money would end up getting credited to NRO. And same is the rentals. Now you want to even transfer that money to NRE from your NRO account. As per the requirements of the banking industry, you would need to go to a chartered accountant who would need to perform an audit. It's like it's a certification, even a higher grade audit of that money to confirm whether it has been completely taxed. Once he gives that certificate, it's here in this format, then you could either transfer money from NRE to NRO, NRO to outside the country, or you can credit it back to NRE account. But this process can be cumbersome because over here, the onus is on the respective person to transfer the money, to prove that the money was taxed. And this can become really, really painful. I'll give you one example of how painful it can be. And we'll take this example of real estate. Let's say around 15 years back, you bought a property while you were living in India for 10 lakhs out of your salary income. Everything was nice, clean, clear. And you moved to the US and now the property value is around 1 crore. You sold it off. The money is sitting here now. You go to a chartered accountant and say, hey guys, I've got 1 crore rupees. Can you please give me a Form 15 CSCB because I need to transfer it to my respective country? The dilemma of a chartered accountant here is the government has put the onus on the CA. His neck is on the line to confirm that the whole money is taxed. Now, some part he can make sense. The stamp duty value of that property at the time of purchase will say 10 lakhs. So that is clear. And the sell value is 1 crore. That is also clear. So between 1 crore and the purchase and the sale price, the 90 lakhs of capital gain is very clear. And he can say, okay, we need to file a return for it. We need to pay tax on it. In many cases, TDS will already be deducted. So it should be fine. So that part is not a problem. The problem is that amount of 10 lakhs which was invested in that property 15 years back. Now, if I am the chartered accountant who's giving you this Form 15 CSCB, in that circumstance, I will ask my client, please show me how you bought this property. He said, Puneet, boss, what are you asking? You was a salaried employee at that point of time. And I paid through my years of income over there. Yeah, I agree with you. Show me the proof. What proof you're asking? 15, I don't have any documents. Then how can I as a CA sign off when you as a client cannot confirm or in terms of prove it to me? Atak gaya? Ladte raho. Unfortunately, diligent CAs will perhaps shy away from issuing you that certificate on that 10 lakh rupees. So it's important to know this is also the repatriation of the part. In summary, what I would want to tell you is that any money which you transfer to India, please make sure you do it via NRE. Do not use this as your primary way. NRO should not be used other than for your normal rental credits. And real estate, be aware of the problem which will come to you at the time of repatriation. So keep a very clean, clear trail of what money was used to buy it. Okay? So that's the repatriation part. The next part, which we are going to talk about, is a common dilemma which NRIs have. Okay, on your chats, do you use saving accounts even while you're a non-resident? Do you use saving accounts while investing in India as a non-resident? Yes or no? Why? N. Or have you observed non-residents while investing in India, instead of using the NRE, NRO, they use saving accounts? Just why, if you're doing it? So Sudhi says yes, Rahul says yes. Okay, fine. Suji says no. Yeah, okay, fine. So effectively, people inadvertently, they are not aware, they continue to use their saving accounts, normal resident saving accounts, to invest in India. And there could be few dilemmas in their cases that I have just gone to the overseas country. I'm going to come back after 6 months. Should I convert? Should I not convert my savings account? I would say, yeah, if you've just gone and you're going to come back, give yourself some room to think. But if you, the ideal way is convert and invest in the right way. Or some constant dilemma which they have is, I may return some point in India. Then should I continue by the saving routes? It's not allowed. These are not legal ways of investing. And the other bit is, which is very funny, which I at times come across, is where people say that I don't want to disclose that I'm an NRI. For all practical purposes, you've left the country. What is the disclosure you're talking about? And as I was showing you in the previous slide, there are more advantages of investing via NRI versus a non-NRI. Your money is becoming more hassle-free. You don't need to kind of have a challenge of filing tax returns if the money has been already, the tax has been deducted. If you need to take the money back, it's super cool way. And my practical experiences, not all NRIs, this particular point. Number two, not all of them come back. Some may, not all of them. In that situation, you are muddling your waters of repatriation. The point is, if something can be done the right way, why to do it in the wrong way? That's the kind of constant dilemma I have. And I try to kind of encourage people that don't do it in the wrong way. A little bit, you can also learn more about us and more about such topics. Here is a contact QR code. You can scan it through your phones and it will give you a form in case you want to connect with us, contact with us with any queries you have. We'll try our best to kind of give it to you, reply back to you. So this is that contact. Every week on week, we kind of are releasing some useful videos and content associated with personal finance. Non-resident topics are also repeated over there. We have a separate playlist on our YouTube channel on non-residents. Even this video will record and put it over there so that people can continue to refer to it if required. All our social media handles are @BanyanFA. So it is easy. We are on Facebook, YouTube, Insta, LinkedIn is through my name, Puneet Agarwal, and also through BanyanFA as well, and on X/Twitter as well. So let me kind of now see if there are any questions. I'll give you a few minutes to kind of let the question and answers queue build up and try to answer as many as I can. And so the first questions, I think so. Mr. Rajesh Mishra has got the question, which is quite interesting. Investment opportunity through Gift City for NRIs. Let me put it this way. I'm very eagerly watching that space to see how it develops. Gift City may have very interesting financial product coming in, which may ease up not only investing, taxes as well. And but don't forget one thing: the concepts of INR depreciation won't go away. If you are investing through a product of Gift City into India, that money will be converted into Indian rupee. So you have to be conscious about what you're investing into. Also, one of the Gift City challenges could be that what if the vehicle where you are investing into invests in a mutual fund again? Example, a mutual fund company opens let's say an alternative investment fund in the Gift City, and from there it invests in a mutual fund, like a fund of avatar. I believe it will still get classified as a PFIC. So please be open to what this is an ever evolving area, and we need to be watching out of what other products come in this area, right? Mr. Pankaj Jain says, would this be shared with the registrants? Yes, it will be. It will be uploaded on our YouTube channel. So kindly use our handle and subscribe to it so that you can be notified when it gets released. The next question comes in from, again, Mr. Rajesh Mishra, that can a NRI in US form HUF in India and invest? Will this attract PFIC? See, again, a tricky one. When you are investing as a HUF, the Karta is actually the details of Karta are logged as a beneficial owner, UBO. You may want to kind of skirt around, but Karta's details, when they are embedded in the HUF, and when you are investing and submitting all the KYC information of Karta, and you say that, okay, the Karta is also living in the US or in the UK, what prevents it not to be disclosed back in that respective country? So you have to be mindful about that, right? A very common way of investing in India to avoid these tax situations could be gifting to parents and investing in their names or transferring it back. I'm not a very big supporter of this way. Yes, it can be a tactical approach to circumvent, is a word to use in this case, of these tax issues. But just think about it. What were we, when many of you guys mentioned that you can get up to 10% return in the respective country, and what we saw in case of tax, the rupee depreciated and tax adjusted is around 10%. Why do you want to then do that skirt around? If you do that skirt around in a parent's name, the complications around estate transfers, what if some sibling is then creating a problem at a later stage? Yes, there might be arguments, pros and cons associated with it, but you are creating problems at a later stage. I don't know in future the inheritance taxes might come in. I don't know how inheritance taxes might be dealt in the future. So if something can be done without skirting around, I want to avoid doing that. That's where I also showed you those examples where you have an alternative approach to invest. Yes, the ticket sizes could be higher, but that it does exist, right? I am not seeing many other questions over here. Okay, people are putting it on the chat. Mr. Ashwin is saying, if someone is living in UK and investing in mutual funds and did not redeem the money, so does it result in unrealized taxes? I don't think so. It gets, it's at the time of realization. So hence, that's where I was mentioning earlier as well, that UK is not great, but it's not as bad in terms of from a tax perspective. Then Himanshu is saying, can NRI transfer in NRO accounts or parent account? I just answered that. The other bit is in India, the financial year is from April to March, while in UK it is Jan to December. I'll clarify. Jan to December is US. UK is also April to March. The only slight difference is UK, I think, so is 6th or 7th of April to 6th or 7th of April next year, something like that. But it is the relatively similar tax financial years. Other bit is, please clarify how direct equity is beneficial than mutual funds. It's basically these two geographies only, which I will talk about, the UK and US, where the problem is with the fund structure. I'm just trying to break that fund structure and go straight into the relevant asset category, which could be if the fund was investing in equity, directly into equity. If it was equity and debt, then same way. So when you kind of avoid that fund structure, my understanding is that it does not get classified under that non-reporting or PFIC norms, right? There could be challenges, yes. Let's say if you are trying to connect with some portfolio management service or PMS accounts and they do not accept for US, but there are some. They do. It's not that they do not exist. Yes, they may not be the ones which you may want to invest in, but they do exist. Some of them do comply with it. So there could be an option for you. Is there another question? So, okay. The next question is from PU. Husband NRI, wife not yet NRI, working, earning and investing from saving account, as she does not have an NRI account. How long can she invest from Indian account and what is the correct way? So if the wife is in India, then obviously she can invest in her own name as a saving account. But what's happening? Husband is earning, transferring his money into India, into wife's saving account, if that's the situation. Why can't it be the other way around? It's a foreign currency amount. Why can't husband open an NRE account and invest in that manner? I think that is also one way to think about rather than transferring, because what will happen is if tomorrow the wife goes back outside India along with to join the husband, and now you want to take the money back. I just showed you what problem it could create in repatriation, right? Are there PMS options through? Okay, that's a US wala part. I told yes, there are a few which do that. We have many US clients who actually use PMS options in that case. Can a formal Indian passport holder and is now a Australian passport holder invest in MS through NRI, NRO? Yes, 100%. There are a few requirements for KYC purposes. You obviously need to have your OCI card, PAN card, NRE account, and you can. So the restriction does not go away. It does not come into picture if you based upon citizenships. What are the tax implications of a Dubai-based NRI on selling mutual funds in India? I don't think so. Dubai falls into that punitive category. So it will be a more like a neutral or a better country to be in where they will not have any punitive taxes. The respective NRI can also consider discussing with the local chartered accountants out there. But my understanding is it may not be a problem area. Then I've got no more than 5 more minutes. Let me see how many questions I can take. There's so many questions which are coming in. Mr. Pankaj saying, thanks for a useful webinar. Thank you, sir. If we want to build up our knowledge on NRI, how do we approach this subject? AMCs themselves look short of experience. Unfortunately, I don't have the right answer to it. And hence I tried my best to kind of spread my understanding through my YouTube channels or doing this webinar. I don't have a practical way to understand, to help you know, these are the ready references associated with non-resident. My point is just, whatever I told you today is the building blocks. Think yourself as a non-resident. If you are a non-resident, will you do that? And then when you will think from their perspective, you automatically, your eyes will start getting open in the directions that what should you do, what you shouldn't do. You saw that example of that FD wala part where I said, would you invest? It's going to be 0 to negative returns. Those kind of situations, and perhaps maybe your peers could kind of guide you in those areas. How is the income received from trust tax for NRIs residing in India? Sorry, sir, I'm not a tax specialist on trust, so I might not be able to reply on that one. Do you have a list of PMSs? I can't disclose those things over here. I don't recommend any financial products on social media. Then Mr. Samir is saying, hey, hi, Puneet. Thanks. It was appreciations. Thank you so much. We will organize future sessions. Yes, thanks, Mr. Samir. Thanks for your feedback. Then what are the tax implications of an Australian passport holder on OCI on investments in Indian MS? I haven't come across any punitive ones. I've come across something in New Zealand area, but that was also not punitive enough. It was just an upper cap of, let's say, around 25 or 30 lakhs. If it goes beyond that, then the taxation might trigger in. But in Australia, I've not come across. Maybe you might want to talk to your respective CPAs over there as well to just understand from their point that if you invest in overseas investments, what are the tax elements? I haven't come across and would love to know more if you have come across something. Then you have, I have a question from Mr. RP. If NRI is in UAE, does Sharia law applies when he dies? Sorry, sir, I'm not a specialist on Sharia law, so I may not be able to answer you that question. Then Mr. Pu has another question. Husband NRI after marriage, wife shifted to husband's country and investing as this. So see, I told you about that part, that this might happen. And how long you can continue to invest. My best situation is if you are now thinking that you're going outside the country, at the earliest opportunity or your next visit, you convert all your accounts. This may, as some persons in the chat mentioned, it's not very strictly enforced, but when it enforced, it will create pain. It's better to do it the right way when you can always and avoid the wrong ways of investing, right? Then I think so I've answered all the questions. So guys, thanks a lot for kind of a good 1.5 hours of roughly of your time. My QR code is here in case you want to connect with us in the future and our social media handles. You will see more regular contents on our social media handles. Feel free to kind of reach out if you need your help. Thanks for watching. Bye-bye.